and welcome to the Business Standard Morning Show. I'm Nazia Iqbal, and here's a look at the stories for the day.
This is GE Vernova, helping generate and move the energy that will change the world. Welcome to a new era of energy.
The impact of the global slowdown is beginning to be felt in India. The country's goods exports have contracted for the first time in 2 years. It saw over 16% decline in October when compared to the same month last year. So exactly what went wrong with India's export story? Our next report answers this question.
On the sidelines of the G20 leaders meeting in Indonesia on Wednesday, the head of the World Trade Organization warned that several major economies were facing a real risk of sliding into a recession. The war in Ukraine, soaring food and fuel costs, and rising inflation were the factors she blamed. The effect of the global slowdown has now reached Indian shores. In October, the country's merchandise exports contracted for the first time in 2 years. The last time when exports saw a contraction was in November 2020. Slowing external demand against the backdrop of recession fears in the West impacted shipments from India. According to Commerce Secretary Sunil Barthwal, both global and domestic factors had an impact on India's exports. These included the tightening of monetary policy in Europe and the US, which slowed down consumption, and the impact of the festival season in India. Based on data from the last 2 years, Barthwal said there was a $4 billion gap in the trade between the pre-Diwali and Diwali periods. So, exports in November may perform better than in October, even though a full recovery will not materialize. Goods exports declined almost 17% in October to a shade below $30 billion. Imports moderated to their lowest level in 8 months. They grew at about 6% to almost $57 billion last month. This resulted in a trade deficit of about $27 billion, which remained above the $25 billion mark for a fifth straight month. The decline was spread across most segments. 24 of the 30 key export items saw a dip. Only 6 items, which are electronic goods, rice, tea, oilseeds, oil meals, and tobacco, witnessed growth. Key commodity groups such as engineering goods, gems and jewelry, chemicals, and ready-made garments saw double-digit contraction and dragged down overall exports. Non-petroleum, non-gems and jewelry exports, considered to be core exports, declined by 20% in October. Let us go into the details of key items. Engineering goods have been a mainstay of India's exports performance in recent years. Exports in this category dropped over 21%. According to the Commerce Ministry, the $2 billion drop included steel and its products. This indicates the impact of the export tax on iron and steel. India's iron ore exports reportedly slumped to nearly zero in October. A senior industry official also told media that overseas shipments were expected to continue languishing because of higher export taxes and lower demand from China. Ready-made garments and gems and jewelry, the country's key job-intensive sectors, saw exports drop over 21% from a year ago.
If you look at the drivers last year, and iron ore, for instance, iron ore and steel, these are the sectors which did the heavy lifting. Even agriculture, rice and wheat were really doing really well. Of course, rice is still expanding, but iron ore registered the sharpest decline among all the sectors, major sectors, in the 7 months or in October. Generally, engineering was doing very well. It did a lot of heavy lifting last year. engineering is down in doldrums now.
Sharmila Kantha, principal consultant at CII, says that on the demand side, inflationary conditions and expected recessionary conditions in major economies seem to have impacted India's exports, particularly of discretionary items like garments and gems and jewelry. On the supply side, she said that the October export contraction can most likely be attributed to festivals during the month, when many factories operate at low capacity. According to Kantha, the machinery sector recorded a moderate growth in the previous month. So, a sharp decline in October is probably a deviation from the trend line. Kantha points out that continued strong growth in electronics is a heartening feature of the export profile and indicates the competitiveness of Indian manufacturers. Electronics goods exports grew almost 38% year-on-year in October to $1.8 billion.
In the global economy is cooling. And I was actually looking at the April to October numbers, and there you can see what is going on, because the April to October numbers, then the negative growth is seen in only 10 out of the 30 sectors. So when the squeeze starts coming towards the end of this 7-month period, then you start, we start feeling the pinch. And again, we go back to the same old problem, that are we competitive enough? And has enough been done in terms of, making our industry more competitive? And then, of course, questions have been asked about the PLI scheme, whether it's started paying dividends.
Madan Sabnavis, chief economist at Bank of Baroda, says that a slowdown bordering on a recession in the West will lead to a decrease in demand in general, which will affect India's exports growth. Therefore, he expects exports growth to slow down in the next few months and probably be negative. He adds that the exports of services like software will also be impacted by the recession, as demand for IT services will reduce. Hence, according to Sabnavis, both exports of goods and services will be impacted, thus affecting the current account deficit. He expects CAD to be in the range of 3 to 3.5% of GDP this year, notwithstanding an inflated denominator, as nominal GDP has been pushed up by high inflation. Actions on the domestic front are unlikely to affect the recession fears that have taken over across the globe. However, that doesn't mean that India should shy away from putting its own house in order. The country's foreign trade policy was last updated in 2015 and was supposed to last until 2020. Now, amid delays from the Commerce Ministry, Biswajit Dhar contends that a new comprehensive trade policy is overdue.
Despite the rough global weather, the auto components sector has shown resilience. It witnessed a 43% jump in exports during the last financial year, and for the first time, the industry has seen a trade surplus. Business Standards S. Tinakar caught up with Sunjay Kapur, the president of the Automotive Component Manufacturers Association of India, to know how the sector is performing and how the industry is transitioning to meet the challenges posed by the rise of electric vehicles. Kapur also spoke about localization. Let's listen in to the interview.
Mr. Kapur, can you give us an update on the auto component sector, especially in terms of the looming threat of electric vehicles?
I will give you an update on the automotive sector with the opportunities of electric vehicles as opposed to the threat, because it's not a threat. It's really an opportunity that we're going to see. The auto component sector has had good growth compared to the last. I mean, in the last year, we grew 23%, pre-pandemic levels to almost $56.7 billion. We saw an export of growth of 43% at $19 billion. And for the first time ever, we've had a trade surplus. So which is really, the first time in our history. So it is definitely a positive. We've seen a lot of opportunities come, whether it be because of China plus one, or it be the fact that we have had sourcing opportunities, outside of India, and therefore our exports have grown. In the domestic industry specifically, we've seen a 20% increase in passenger car and a 30% increase in commercial vehicles. So definitely looking much better than it was from before. Again, there's been a lot of technology disruption in the automotive space per se and as a whole. And when I talk about the automotive space, I'm really talking about it from a global perspective. We've seen a lot of technology disruption, and that's brought about a lot of opportunities, not just from the vehicle, but the ecosystem as well. So if you look at the vehicle, what's changing, in terms of, one is the electrification of the vehicle. The second is connectivity. Then we go on to telematics. The kind of technology being adopted in vehicles is changing drastically across the world, and that's slowly being adopted in India as well. Then if you look at the ecosystem that comes along with that change, or the requirement of the ecosystem, and when I talk specifically about EVs, you look at battery technology, charging infrastructure, all these are opportunities that are being created. When you take ICE, to go back to your question, the ICE is not going away per se. And we're going to see that continue for quite some time, specifically in India. Passenger car outside of India, yes, several car companies or OEMs have announced that they will go electric and not build the ICE vehicles any longer. So that becomes an opportunity for Indian component suppliers to supply to as well.
There is a shift, at least in the developed markets, towards EVs in an aggressive fashion. Especially after the Russia-Ukraine war, there's a much more emphasis on alternate fuels. So where do you see export markets for Indian component makers in this shift?
So our largest export market is the US, and I think that'll continue. We will continue to, we're investing heavily in technology. So if you now look at the government PLI schemes, they're all geared towards investment in future technologies. As we invest in future technologies, we have two benefits there. One is the deep localization benefit, which allows us to not be dependent on other countries or dependent on imports, and therefore, again, going back to trade surplus, and the opportunity to export. Now, when you look at electric vehicles and all the investments that companies in India are making, the capex cycle that's already kicked in, we need to have a large market to supply into. And therefore, India is a very small market from that perspective in terms of volume of EV. So when we really want to tap into the market, we're looking at exports as an opportunity. And that's why I said, with the growth of 43% in exports, we hope that this continues. We've got a lot of international purchase organizations or offices, as they call them, IPOs, in India, sourcing for OEMs as well as tier one suppliers. That is again an opportunity for the component industry to supply into. Having said that, and I continuously say this, it is our role really to invest in technology. And the more we invest in technology, the more opportunities that will open up for us as a country, as a manufacturing base, as a manufacturing economy. Because one is, the make in India. The other part that is more critical from my perspective is design in India. And once this continues, we'll see more export opportunities. ACMA and CIAM are working together to localize parts. So we're working on projects together to see how we can increase the localization in India, and therefore again have, a stronger trade surplus than we've had in.
From April onwards, the government had increased import duties on import of solar modules and also brought out a list which mandates purchase of modules only from domestic manufacturers. That, I believe, was needed to spur investments, because even with the PLI scheme, the Chinese threat was big enough. Now, do you see something like that being needed for the auto sector or auto component sector, where the government mandates local purchasing instead of imports? You think something like that for 2-3 years will help spur investments further?
I'm not a big fan of that, because again, if we don't invest in technology, we're really going to get left behind. So, for us to get into a system where, government mandates that a certain percentage has to be bought locally and we don't have the tech for it, it's not going to get us anywhere. I would rather the government do what they're doing in terms of saying, here you go, here's an incentive. If you invest in technology, you're going to get an incentive. Give us that incentive, allow us to, or encourage us to invest in technology, and therefore encourage us to supply to the world. We should be creating an automotive manufacturing hub in India to supply to the world. That's really where we need to go, and that's the vision of the auto component industry from my perspective. And how can we really create that hub here so that can supply it into the rest of the world? Because we have the capability, we have the ability, we have the manufacturing capability as well, and we are able to develop technology. So we should be comparable to an industry anywhere in the world, not just India.
Thank you very much, sir. Thanks a lot for your time, and you seem very positive about the industry, and let's hope it goes that way.
Yeah, let's hope so.
Geopolitical tensions have pushed the prices of Brent crude oil by 13% in the last 1 year. It once hit the $130 per barrel mark during the period. And as OPEC plans to cut supplies to maintain prices, analysts see 2023 to be a tough year for Reliance Industries and other oil marketing companies. Our next report explains various scenarios that may play out in the oil market next year, and what it means for investors in RIL and other oil marketing companies. Global crude oil prices have bounced back nearly 19% from their September lows, ever since the Organization of the Petroleum Exporting Countries decided to cut production by 2 million barrels per day. From a low of $83 per barrel, Brent crude prices surged to $98.5 per barrel early November as OPEC's decision came into effect this month. Citing a study by Facts Global Energy, global brokerage firm Jefferies observes that OPEC may defend oil prices in $90 to $100 a barrel range and adjust supplies to balance the market. While there could be limited impact from EU sanctions on Russian crude imports, the reopening of the Chinese economy could result in an incremental oil demand of nearly 1.5 million barrels per day, which presents an upside risk to oil price. Analysts say the ripple effect of the international turmoil could be felt by Reliance Industries, Hindustan Petroleum Corporation, Bharat Petroleum Corporation, and Indian Oil Corporation back home. According to Jefferies, RIL's O2C segment could see weaker profitability in 2023 if refining margins weaken. Lower refining margins will also hurt OMCs. High oil price could result in continued marketing losses on diesel with no clarity on further government support. On the demand front, OPEC forecasts oil demand to increase by 2.24 million barrels per day in the next calendar year, down 1 lakh BPD from the previous forecast. At the bourses, stocks of oil marketing companies are barely trading above their respective 52-week lows. So far in calendar year 2022, HPCL, BPCL and IOC have lost up to 28% as compared to around 6% rise in the S&P BSE Sensex. The S&P BSE Oil and Gas Index, however, has risen 15% during this period, though mostly attributable to a 10% rally in RIL and a 126% gain in shares of Adani Total Gas. Going ahead, analysts see the pack feeling the heat in the near term.
Last 5 years, HPCL, Hindustan Petroleum and IOC have been underperforming the market overall. Now, BPCL was higher. Only one reason, it is because there was a stake sale and talk, and as that fizzled out, that is also underperforming for the last 2 years. We have lot of state elections, so I don't think petrol and diesel prices will be volatile. They will not be hiking on a regular basis. So prices have to be kept stable for government, because we are more of a democratic country. If that is the case, and if international prices are not going to come down, then OMCs will not be making huge profit. Already, whenever prices are volatile, there is a huge inventory loss for this oil marketing company. And that is slightly negative. And if you see the trade data also, our exports on that front has come down. That means local demand is increasing, whereas there is no supply. Globally or locally also, there is no supply. So that will put more pressure on Indian PSU OMCs.
Today, geopolitical tensions, oil prices, foreign fund flows, and weekly F&O expiry will sway the markets. US Treasury Secretary Janet Yellen, who was in New Delhi last Friday, said that her country will pursue the friendshoring approach with trusted allies like India. But what is friendshoring? Let's decode it in our next report.
Friendshoring is a strategy where a country sources the raw materials, components, and even manufactured goods from nations that share its values. And dependence on the country is considered a threat to the stability of the supply chains is slowly reduced. It is also called ally shoring. US Secretary of Treasury Janet Yellen said in India that Russia has long presented itself as a reliable energy partner. But in the Ukraine war, Vladimir Putin has weaponized the gas against the people of Europe. She said that it was an example of how malicious actors can use their market positions to try to gain geopolitical leverage or disrupt trade for their own gain. Another country Yellen mentioned in her speech was China. She said it currently controls over 80% of global solar panel production. However, there are reports that in parts of the country, like Xinjiang, the production of panels takes place through forced labor. Apart from geopolitical and security risks, the US will also reduce the reliance on manufacturers whose human rights values clash with America's. Yellen said that companies have been shifting to India. A development finance institution is providing America's largest solar manufacturer with up to $500 million in debt financing to build a facility in Tamil Nadu in India. She also gave examples of Apple's announcement to shift its iPhone manufacturing facilities from China to India. Yellen had earlier mentioned the term in a speech at the Atlantic Council in April. She said the US would continue favoring the friendshoring of supply chains to securely extend market access. It was later visible in the case of semiconductors. In May, US President Joe Biden toured a semiconductor factory in South Korea. It was seen as a step to move away from Taiwan, a major US semiconductor partner, and is under threat from China. Some experts believe that friendshoring may push the world towards a more isolated place for trade and reverse the gains of globalization. It is a part of the deglobalization process. Yellen, however, said that friendshoring was not limited to an exclusive club of countries, and thus the US believes in economic integration.
I will achieve, I will fly high. nation's trusted bank, SBI, the banker to every Indian.
The West is slowly drifting away from unfriendly countries like China and Russia by reducing their dependence on them for energy and materials such as rare earth and other minerals. And friendshoring is a step in that direction. Well, that's all we have for you today. We will be back with more news and analysis in our next episode. Stay tuned. Thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.